What is going on, guys? Welcome back to another episode of the Listen podcast. My guest today is an entrepreneur and financial content creator with over 1 million followers across his platforms. His content focuses on helping you make more money and keep more of that money. Nathan Kennedy, aka New Money Nate.
Pleasure to be here, man. Thank you for having me.
Thank you so much for coming. I got so many questions because I feel like young adults especially are so bad when it comes to financial literacy. A lot of it because we weren't taught a lot of these things growing up. So how did you kind of get started with all this, creating content on finances and just, I guess, becoming financially literate?
Yeah, man. You know what? I think from a young age, like my family and I, we didn't have too much money. So I always felt like I knew the value of a dollar, but didn't really actually know like the practical like tips or steps or anything around it. So when I went to university, I realized that I actually didn't know jack all about, like money for real. So I just went down the rabbit hole of like every podcast, book, resource that you could find online to try to like teach myself, like how do I pay off my credit card? How do I start investing? All that jazz, and fell in love with it. And so, you can only annoy your family and friends so long before you're like, man, like I'm just gonna, like I couldn't help but like share what I was learning. So I started the pod like a few years ago, I think 2018, 2019. And then like used Instagram and TikTok to promote it. And then eventually like the social channels just kind of took off and the podcast is still around now, but it's more so like the social channels around that. And I was just so shocked that people were like actually like thirsting for the information. Like, and so I just kept making it and that was kind of that.
Yeah, I agree. I feel like it's kind of like addicting a little bit so I kind of started getting into that whole world during COVID. And my friends kind of at the same time, everyone was slowly getting into it, like investing, learning about TFSAs and all that stuff. And it kind of like, it became like the only thing we were talking about. So like, oh, I found this stock. This is really promising. I found that like, oh, what's your contribution room, all that stuff. And like I said, I feel like a lot of it is because like we were not taught a lot of these things in school. I don't know about you, but like we're basically the same age. I was not, like in Ontario at least, we are not taught about saving, investing, student loans, paying your taxes, any of those things. Like, why do you think that is?
I think now, actually, I think Ontario actually announced that they're going to start actually implementing it into like grade 10 math or something like that, which is like promising. Now, to the extent that it actually gets implemented, like we'll see. But so it is starting to shift now. But no, they didn't teach us at all. I'm not one of those conspiracy guys that says they want to keep us dumb. They want to keep us as workers. I think that's ridiculous. But, I think for the most part, the people that we're teaching aren't really financially literate either. And so it didn't really seem as though it was one of those things. And it was also taboo previously. To talk about money was sort of bad taste and to talk about it so openly. And I guess maybe it fell out of the purview of the education system and maybe they think that's more of like a personal thing. It is personal finances. So maybe that's it. I don't really know because in the United States, actually, they say they don't learn it in school, but they've actually been teaching it in school in a lot of states for a long time.
Really?
It's just nobody's really paying attention when they're younger. So they're not really effectively teaching it. But now it's starting to be implemented at a higher level. And I think that's happening across Canada too.
Yeah. I kind of hate that it is taboo because I feel like it's definitely getting better, but it still feels like it's a thing, like specifically just like how much money you make.
Yeah.
And I feel like in our industry, like as content creators, it would be like, I had someone on last week and we spoke about this, but it would be so much more helpful if we were all open about like how much you can make as a content creator, how much you should charge brands and that kind of stuff, because it feels like everyone is like scared to talk about how much they make because they're afraid they're not making as much as their colleagues. But it's like, if everything was out in the open, we would all make more money.
Yeah, no, and I try to be really transparent with that, like within the people around me and everything like that. I think, obviously you got to respect people's privacy, and I'm not one of the, I'm not like, I take hard stances in some areas, but I really don't love people that are absolutists. And to say everybody should always be transparent about every dollar they make, I don't think is too fair.
For sure.
But I do think it does help in a lot of ways. And, sharing, the insights that you get, because I'm a huge proponent in negotiating. Like I talk about negotiating a lot in my content, but I negotiate, like I go hard in the paint when it comes to like brand deals and business and everything like that. And, these companies have so much money. And so you just try to ask for more and more and see, how many no's you get. But I do think when you share that kind of stuff, people are scared that, maybe people will undercut them, right? And it becomes sort of like a zero-sum thing, or maybe, they get judged because, well, they're not worth this and that. And they'd rather not have that conversation because believe it or not, man, like, I've told people and I've gotten a wide array of reactions to it. And so some people just don't want to even deal with that. So it's a very complicated thing. But I do think, generally speaking, people should be more open about it 100%.
Yeah.
Yeah.
I feel like something I really like about your content is that you do a lot of these negotiation videos. And I feel like a lot of people don't understand that you can negotiate in a lot of these situations. And a lot of your videos specifically are like negotiating, like, for example, a job offer. And people, like, do you think it's people are afraid that, like, oh, the offer is going to be taken off the table if I try to negotiate for more, or I'm being greedy asking for more?
Yeah.
Do you think that's kind of where the fear is?
Yeah, I would say so, because people, it's just the sort of like irrational thought in your head, like, if you don't take something the second you have it, it's going to be gone. And, there's this nature of like being ungrateful, like gratitude and negotiating seem to be on two ends of the a different spectrum. But like you could be them at the same time. You can be grateful and still negotiate for a little bit more. And I think people say, well, if you negotiate, you're ungrateful. And I don't believe in that. And so I think generally one of the best negotiation tactics that people don't use is just saying no. Like I wrote something recently, like in my newsletter about it, how like a lot of time, like recently I had a negotiation where I sent over an offer, they sent over a counter offer, and I was like, no, like, let's do our offer. And that's all I said. Like, I didn't say, can we do this?
Deal?
Yes,
okay.
yes. I didn't say, can we do this? Can we do that? I said, politely, I said no without saying no, right? So how I always say it, like, people are scared to say the word no, and you don't actually have to do that until like 3 or 4 no's down the line. You could say, I'm so sorry, that doesn't work for me. Could we please do the proposed price above, right? Just send that over. And then they'll send over a higher offer. And then you just say no again. And then they're just negotiating against themselves at that point. And then later on, that's when you send over a counter. And so I think oftentimes it's people overcomplicate it and think they have to have the perfect strategy or mathematical way to negotiate. And it's like, well, you sent over a price, they sent it back. You can just say no, and they might buzz off, but like, probably not. And if you're, I feel like as though people are a little, you need to have sort of an abundance mindset to do it, right? Like if you really can't afford to lose it, I totally understand. But there does have to be that air of like, yeah, like this is kind of what I want. And you have to be willing to walk at a certain number. But for the most part, people are afraid of that, right? I think generally people aren't going to pull an offer just because you send a counter offer. Like, and especially with job offers. Like, I actually don't really, I maybe heard of once or twice where you get a job offer and then you send over a counter and you're saying, hey, could we do this? And they just pull the offer. I always say, if they're the type of company that does that, then you don't even want to work with them to begin with.
Absolutely.
So it's like you win either way, in my eyes. Now, people might disagree with that depending on their circumstances. But like, generally speaking, I think like, do it, because either they're a bad employer and they're not going to give you a raise when you want it. And they're going to just say no and pull the offer. Okay, great. Now, red flag out of the way. Or you get a higher offer. And that's, I think that's a win-win. So
yeah, I completely agree. I feel like it's just like you said, it's this fear that the offer is going to be pulled, but it's like, that's not really that realistic. I'm not saying it could never happen, but like you said, if a company is willing to, or is going to pull their offer simply because you tried to negotiate, then it's like, why do you want to work with that company in the first place?
Yeah. And so I just feel as though it's a self-worth thing and absolutely, but and you don't also have to be like a total, like, hard ass. Like you can be very polite. Like I'm very polite when I try to negotiate, right? And it does help. And, you don't have to be this hard-nosed, whatever the guy, in the movies, the hard negotiator banging the table, all that kind of, no, blah, blah, blah. That's not how it is. It's just basically saying like, hey, can we do what I want? Like, please?
Yeah.
Like
100%.
And believe me, it actually works.
Yeah. And I feel like especially in our industry, like, when we're talking to someone negotiating prices for a deal, like it's not like we're talking to the boss. Like they're the ones who probably came and reached out to us.
Yeah.
And they are open. Like it's not like the money if you ask for extra money, it's coming out of their pockets. You know what I mean? So a lot of the times they are open to having those conversations. And for me, when I started, now I have an agent, and I hate negotiating.
I live for it, man.
I know. So it's like, so for me, it was like, this is like my least favorite part of the job. Yeah. So now I have someone that does it for me. So I'm very happy for that. But before, I was doing it all myself, and I didn't know how much to charge because, like I said before, a lot of content creators, we don't have these open conversations and stuff like that. And I talked to one of my friends who like he studied business and stuff like that. He's just like, don't give a price, just ask what their budget is. Yeah. And I felt so weird doing that because I'm like, that feels like I'm asking like basically how much can you pay me? But it's like, no, like that's the way the game goes. Like ask what their budget is. Like they'll give you an answer, or they might try to tiptoe, but like eventually you can get that answer out of them.
Yeah, I know, and that's true. And I do think how you triangulate stuff like that, and how I did over time was just obviously doing a lot of deals, which I've been super lucky about, but also talking to a lot of my close friends and circulating and they're talking. But I have an advantage because I'm a finance creator, so I'm talking to other finance creators who are like money minded. So like we're less likely to be like guarded about how much like. In fact, we're a little bit too open about how much money we make. So it's great in there. And so I have a really good general sense of rates and did the different agencies and how they like to negotiate. And so you get those idiosyncratic sort of like tendencies. So you have a sort of an advantage. But I think in other niches, I've found it's not the case. Like other fashion creators talking to each other might not have the same, I guess, acumen around like negotiating or whatever. Or they're all, a lot of them are managed, or fitness, or, I don't mean to out fashion, like fitness or, lifestyle or whatever, right? So I think I'm happy that's the way it is for me, but I do think generally creators should share that. And if they want behind closed doors, like they don't have to make a YouTube video with a clickbait thumbnail saying I made X dollars with this company. In fact, I'm pretty sure you can't do that for those contracts. But yeah, man, I do think being open is good for that.
Yeah. What are your thoughts? Because you're talking about like being open. What are your thoughts on different content creators? I follow like quite a few people on YouTube who just like talk about the stock market, and they like their portfolio is just like boom out there, just to be completely transparent, so that people don't think like, oh, like you didn't actually make this much money last year, or like your returns aren't as high as you say they are. What are your thoughts on that?
Yeah, no, if your content is boasting about your returns, then like be transparent, right? If you're giving general tips, like for me, for example, my portfolio is just all ETFs and exchange, like all the stuff I'm talking about, S&P 500, like all of that is that's my portfolio. So I really got no crazy returns to show you, and I don't really flex them like some of the YouTubers and traders do. A lot of those guys are full of it to begin with, but that's a whole other conversation. So I think if you're going to talk all this noise about how much money you make, then people are going to put it on you to like, okay, show. But if you're not really like out here talking about that, then like I don't really think it's a necessity.
Yeah. Yeah. I like that you said a lot of basically your whole portfolio is like ETFs and stuff like that, because mine is slowly becoming that. Because
what did it start with?
Oh man. So it started with stupidity. So when I got into investing like during the pandemic, I think I started like the beginning of 2021, before there was kind of like quite a dip, mid 2021. And like I was trying to make a quick buck. So I'm like, well, what's something that can like skyrocket? So I bought like this Chinese car company, NIO. Like I bought stock in NIO, and that like nosedived. And like the whole GameStop, AMC.
Were you caught up in that?
I was. So and like I could have made money. So I was in it like early, not the GameStop, but AMC specifically.
Or like BlackBerry or whatever.
Exactly. And I bought quite a bit of AMC at like $10 a share. And we were like, my friends and I were following it. I was like on Reddit every day looking at what all these people were saying. And it like over the course of a few weeks went up to like $60. And I'm like, now as the investor I am now, I'm like, I would have taken that money and ran with it. Like $60 is such a huge return.
Yeah.
But at the time, like we were listening to all these people that were so bullish on it, and they were like, this is what's gonna happen, and no, this is just the beginning of the short squeeze and this and that. And like we're so silly. We're kids, but like at the time we're like, bro, this stock's gonna run to like $1,000 a share. Like we were so delusional. And we're like, no, hold, like
diamond hand.
Diamond hand. Like, no, you can't sell. And then slowly went from like 60 down to 50, down to 40, down to 30. Now it's like, I don't know, they did stock split. I think it's like $4 a share.
Oh, man.
So I try to look at it as a learning. Like I was able to learn from it. It was an opportunity to learn. I lost quite a bit of money at the time, but now it's like, okay, now basically all of my money is in ETFs and just and I've been having really good returns, like VFV, XQQ, that's basically what a lot of my investments are in.
Long-term forever picks, man. Yeah. Those are great.
And I think for me, it's become a thing where I'm like, okay, I can buy that and hold and not have to worry about it. Whereas
never have to worry
with the other stocks that like when I was in the beginning investing in and trying to like, make some quick money, I was like, constantly you have to keep track of like what their quarterlies were and who the CEO is, and every week I'm getting in the mail, vote for this and vote for that.
Yeah.
I'm like, I'm not financially savvy enough to keep track of all these things going on and work and do all these things.
Dude, it's funny you say that because people have this notion of investing that it is that, right? Like it's all this legwork, doing all these different things. And I always try, that's why I share like index funds, ETFs are very, very passive. Like you just buy and hold and just keep plowing it in, and you don't have to do anything. You don't have to do any research because a lot of these ETFs, like VFE, for example, the S&P is self-cleansing, right? The bottom 3 companies, if they don't meet their earnings, if they don't meet their profitability standards, if they don't basically meet like metrics, they get dumped, and then the next 3 companies get come up, right? So it's constantly having the top 500 in the United States. And it's pretty crazy. I mean, like even right now, you know, NVIDIA is on a tear. NVIDIA is the most valuable company, I think, in the world right now, other than like maybe Saudi Aramco or something like that. But like in the United States, and certainly it's probably the most valuable company in the world off this AI rip, right? Because it's the marquee company. And, you know, you have a lot of people, you know, aping into NVIDIA, right? NVIDIA's always been a massive company, but now it's the bee's knees. Now, you could say that's an example of like, I don't know, that like it's not the worst thing in the world because that's it's always been a massive company, well, for the past decade at least. But you have a ton of exposure with that, with my ETFs, your ETFs, and any of these companies that soar. Like even when Tesla got included in the S&P, like you got a ton of upside because of that, right? So you didn't. Sure, you would have gotten rich if you were in Tesla early or any of these certain stocks early, but that's just not likely. And for every company that does happen for you, it's more likely than not over time you're going to pick 5, 6, 7 that don't do that and don't do that in a really bad way, right?
Like Neo.
Yeah, there you go. Yeah.
So what are your thoughts on a stock like NVIDIA? Because for me, it's like it feels like every day I'm getting a notification that they're at an all-time high, and it's like I feel like typically it's not a good idea to buy at an all-time high, but like I said, it's like every day they're hitting a high.
Yeah.
What do you think about a stock right now like NVIDIA that's like not to say inflated, but just like you said, maybe the most valuable company in the world right now?
Yeah.
Is that a good idea is it a good idea to invest in a company like that, or is it just it's gone? It's ran so high already that it's like, can it continue this?
Yeah. So I think generally you need to, first thing before you wonder what you like want to invest in. I'm pretty against flipping in the short term in the stock market. So any sort of stock that's having a run up, like I'm like, okay, like if I buy right now, what's the 1-year return? What's the 3-year return? 5, 10? Actually, more so, I'm 5, 10, 20 and onward, right? Most people that want to get into NVIDIA right now want to make like, they just want to like get their money out next week and just make like $100 or 200 or $1,000 or whatever it is. And I'm pretty, it could just as quickly turn the other way. I think if you think long term that it's going to be a great company, then yeah, like you could slowly dollar cost average into it, or in other words, like just put a little bit of money over time into it. But like, again, an ETF has NVIDIA in a very big way, like especially if it's weighted to the market cap, right? So it's like you're getting that upside in some way with a lot less risk with a lot of ETFs. But I generally don't think it's the greatest idea, because the second, it's like Murphy's Law, man. The second you like put a few $1,000 in NVIDIA, that thing is gonna lose 20% of its value. And yeah,
it's tough because it almost feels in a way like it's like, I don't like to say investing is gambling because, you know, it's much,
I think in the short term, it certainly can be.
In short term, yeah. And I think that's what's dangerous. And I think that's where a lot of my mistakes came early on in my investing career, was I was trying to make a quick buck.
Yeah.
And now I'm very much in the same boat as you, where I'm like, I'm buying these ETFs, and I'm like, I don't even have the thought of selling anytime soon.
Yeah.
I'm thinking, wait, like more than 10 years, more than 50, like just all the way down the road.
Yeah.
And you've made quite a few videos that kind of highlight that, like how important it is to invest early at a young age. And I think it might have been a few weeks ago you posted a video where it was like, like one person was investing $500 a month at the age of 20, I think, and then the other person was trying to catch up and at 30 started and put 1,000 in. And it's like, well, the person who was like putting 500 in a month and stayed like that forever, still ended up making more money because of how early he started investing. Yeah.
Well, you know, it's crazy. I think in that example, the guy stops at 30 and he doesn't invest for 35 years. And the guy starts at 30 and he invests for 35 years, investing double. He can't even catch up, man. It's just because the guy had such a head start, and that it's just a snowball that compounds over time, right?
Yeah.
Like, yeah, if you think about it, like the guy probably had like 100 grand at 30, and then he just let that thing cook for 35 years. Like, imagine what that turned into, millions of dollars, right? And so that's why like time is the greatest lever. And so if you can get in just a bit early, like it can really, really compound and turn into something insane. Now, theoretically, everybody's like, yeah, like invest early, like, yeah, like lose weight, like, yeah, like hit the gym, yeah, like meditate. Like, I understand these
Easier
things
said
are
than
like,
done.
and that's why I focus on the emotional part of this stuff, is because everybody knows what to do theoretically. Like, I should invest, I should start some sort of side hustle or business, I should make money, I should be in good shape, I should get enough sleep. Like, I could list it off. Everybody like that. Everybody knows that. But so I try to share videos and like here's how to feel differently about it, and here's what might make you just think a little bit longer about what you want to do and motivate you a little bit more. And that's my goal. It's not to like really like the content is like, sure, like once you like we're talking about, it's very straightforward once you get it. It's the actual like emotional aspect that I try to focus on.
Yeah. I also feel like a lot of it is the fear of like not understanding at first. Like I have conversations with friends, and like it takes them a while to like pick up on it, but then it's like once they get it, like they get it. You know what I mean? Like it's not as complicated as it looks. No. It just feels complicated. And I guess that makes me question, like, do you feel like a lot of financial institutions almost make it seem more complicated than it is for you to feel like you need their help to make money?
100%. That's always been the case. I think now, I've even seen some messaging from TD. I think it was TD or like a major bank where it was, maybe I shouldn't out TD, but whatever. I think it was one of the major banks did a Scotia.
Scotia, okay.
And they were doing on their Scotia advice thing. And they basically showed like this montage of like, anecdotes, like these actors basically saying, you should do this or you should do that. And like making fun of influencers, making fun of guys like me, but like maybe more the unscrupulous guys on YouTube that are telling you to day trade and all that jazz. Doing that kind of stuff. And then they're like, no, don't listen to anybody but us because we're the experts. Now, I think a lot of bank advisors couldn't rub two pennies together, man. I'll tell you, like, and they're not even, CFPs or, credentialed in that way. They're sort of just like, they're just advisors, but I don't actually know what their credentials are.
Employees.
and dude, the portfolios they'll put you in, unless you like know what you're doing, are brutal. Like they'll put you in things that have, 100 times, 200 times the management fees of something like, VFV or XQQ or whatever, right? And that can compound to hundreds of thousands of dollars, if not millions of dollars over time, assuming you invest for that long.
Wow.
In fees, right? Because if you're charging a 2% management fee over time, and you get a 10% return, or you have a fund that's as an 8% return and they take 2%, over time, if it's like that $500 example, let's say two guys, $500 each for like 40 years, like that will be a 7-figure difference just from that 2%.
Wow.
And people don't really understand. That's why it's so important to like not only look at the fees, but like understand what you're investing into. And so I do think advisors make a lot of sense for a lot of people, because as much as we're saying all of this stuff, it's better for you to be invested than not. You not having any money is better than that scenario, but or is less worse than the other scenario. But I essentially think that overall, if you can understand it and work with an advisor, that could make a lot of sense. But just got to be super aware of those management fees. Yeah,
it's tough. Like I feel like it's just a good idea to learn it yourself, because it is your money. And I feel like a lot of people think, oh, I have a financial advisor, so I don't even need to think about anything. Just let them handle it. And it's like, but you should probably know where your money's going and what these fees are and what they mean. And yeah, it almost feels more complicated to me to go to a financial advisor than me being able to look at my portfolio all the time and see exactly where I'm in and I can make the changes. And,
I do think, eventually I think I'll have some sort of person that some sort of consultant or somebody that I'll chat with maybe when things are a bit more complicated or more legal, or if it's like estate planning and trust and things like that. Like you'll actually need you can't self-teach law. Like you'll need a lawyer eventually if you're doing well enough and all that kind of jazz, and maybe somebody who can give you financial advice. I think just being super aware of who's giving you the financial advice, and how they're enriching themselves and, their fiduciary duty to you and everything like that, is super important. And I think banks are ever present in our life. So it's just go to the bank, just trust the bank. Like it's easy. And I'm not saying they're the worst people in the world, but you know, they'll pull the wool over your eyes if you're not looking.
Yeah,
You know?
I know some idiots that work at the bank. So, so okay, let me ask you, because I really like the idea of like putting away, you know, as much as you can every month, and just kind of having that set amount every month that you're putting away, investing in the market. If you're someone, for example, who say you've maxed out your TFSA, your FHSA, your RSP, and you still want to continue to put money into the market and invest, what is the next best option? Is it just as simple as just opening a regular investment account and paying the fees and the taxes?
Yeah, man. I mean, I think if you're if you're doing that, you're like in the 1% of
Yeah.
like people our age, right? Like where you've maxed out all your accounts and you're just like, where do I put this excess cash? Like that is such a privileged position. So that's awesome. I think if that is the case, then you know, there are different things you can think about. Like if you're really trying to get ahead of it, like RESPs and setting up for your kids in the future if you're there, or or if you know you're gonna have kids, that could be a tax deferred way. Yeah, try to, I guess, max out every tax deferred option that you can, or tax free option you can, and then yeah, like a standard brokerage firm can make a lot of sense. I mean, when you put the money in, like you don't pay taxes until you actually realize the gain, right? So it's not like it's going to be super impactful for you right away. And if you're investing for the long term, you can plan from a tax perspective down the line, right? Because a lot of this money should be for the long term. So I wouldn't really stress. Like you can open a regular brokerage and invest, and it's not really you're not really gonna feel it until you start to sell in a few decades or whatever. And then at that point, like you can tax plan with a CPA or something like that to figure out like what makes the most sense.
Is it like the gains that you get from a regular like brokerage account, is that like it's considered income tax, and that's what you're like how you're taxed, or is it?
It would be a capital gain, right? So I know there's a lot of noise around like capital gains tax inclusion rate, and basically like before half of your 50, like let's say you made $100,000, you'd be taxed on 50% of that gain. So you'd be taxed as if you made $50,000, not $100,000.
Oh, okay.
So $50,000 is tax free, and then $50,000 is taxed. So that's why it's pretty sick, because
I didn't know that.
Your effective tax rate like reduces a lot. Now, what's going to happen, I believe, for corporations, I think all capital gains are going to go from that 50% to 66%. And then for individuals, I think up to 250 grand is going to be 50-50. And then beyond 250 grand, I believe, will be that 66% mark, similar to like a marginal tax rate, right? So generally, I'm kind of disappointed that they're taking that away. I think it's effective this month, I believe. I haven't looked at it in a while.
This is a federal thing? Canada-wide?
Across everything. So that's a lot of doctors and a lot of entrepreneurs got a lot of healthcare professionals, doctors, lawyers, or doctors, dentists, as well as lawyers. And a lot of people who keep a lot of their wealth in corporations were furious because that's a retirement account, right? And so that changes, hundreds of thousands of dollars for them. Now, nobody's really crying for them, right? They're still doing fine.
Of course, yeah.
But it's still like another notch in the belt of Canada moving away from, economics and being, a place to like grow your wealth and be successful and things like that. I think we'll see how much that actually impacts it. But generally speaking, yeah, man, like if you open a brokerage account and put the money in, like it's not really that different until you actually sell, and then it'll start to change.
Yeah. So what are your thoughts? That's kind of what you think about, if you're in the great position where you have a lot of money, you can invest it. What about the opposite side where people say they simply just don't have enough money to invest, that, they're barely making ends meet as is? What are your thoughts on that?
I do think like obviously reevaluating your budget and like try to figure where you're at, but you can only cut down so much, like especially in a place like Toronto, or especially like, you're going to have to like your expenses are going to be a few $1,000s, like between rent and insurance and your car and everything like that. I think what you drive and where you rest your head at night are the two biggest things that I think people get in trouble with. I think people are driving like $50,000-$60,000 cars and they don't make $50,000-$60,000 a year, right? And it's crazy to me. But the way you go to a car dealership, the way they set up the payments, and then it's like your payment's $300. Like, oh, that doesn't sound so bad. $300 for like the next 10 years or 8 years or whatever, 96 months or whatever it is, right? 8 years. It's crazy, and that's that. Over time, that's compounding interest at like, I don't know, 8, 10. If you've got a bad loan, 15%. Like that's an insane amount of money you're paying. And so those are one of those ones that's really tough to get out of, because once you've bought the car, once you've taken out the loan, like that's kind of that.
That's it, yeah.
And so focusing on that and focusing on like maybe your living expenses is super important. But they're less movable, right? You can only scale back so much on your food and your Netflix bill and whatever. Like that's not really going to do too much. So all that being said, I think focusing on making more money typically is the cure. If you can keep your expenses stable, at least, because a lot of people like they'll make more money and then they'll spend more money, right? If you can make more money and create more of a delta, you'll get and just give yourself a bit of breathing room. Like it'll go a long way, and then that's when you start investing. But investing's like the seventh or eighth thing that people should be worrying about, to be honest. Like a lot of it is the first stuff that I was talking about. Like just getting that like balance sheet in order. Like, dude, I have friends that, they'll be like, yeah, like I have like a few $1,000 in my credit card and I'm just like freak out. I'm like, what? Like I freak out less these days because I've just heard a lot.
Like that they have to pay off on their credit card?
They're like, man, I got like $4 or $5 grand on my credit. I'm like, what?
Yeah.
Like that's crazy. But
I'm like a bi-weekly guy. Like every 2 weeks I pay off my card.
And I'm like, that's crazy. But like people, they're just like, yeah, but like whatever. It's only cost me a few like $100 or whatever. And I'm like, what? and so they just don't feel the pain, I guess.
Yeah.
Maybe that's what it is. But it's so easy to just like swipe off the app and just not look at it and continue on with your life.
Yeah.
Only when it gets really hairy is when like, they're sending collection letters and your mom gets one and it's like, what the hell is this? That's when it gets real for people. But I think you really don't want to find yourself in that position because it is very, very uncomfortable. Yeah.
Yeah. So what are your thoughts on credit cards? Because I'll be honest, I love my credit cards and I have a very healthy relationship. I pay them off on time, always. Like, but I love getting points and all that stuff. So what do you think?
I love credit cards.
Yeah?
Okay. I love credit cards. If anybody listening to this is in Canada, like I've made a ton of credit card videos on like the MX
Cobalt. Oh, don't get me started.
MX Platinum and the TD, Visa Infinite Privilege and like all those different great cards. I think credit cards are awesome because you get the points, the travel rewards. You can get perks like, you're at an airport, you can go to the lounge and get free food and all that jazz. It's amazing.
Pearson's kind of sucks. But
Yeah. A lot of them are.
There's some other good ones.
There's definitely some good ones. Like I was in LA and I went to the Centurion Lounge, like the American Express. That one's dope.
I saw they had the same thing in Vegas, and I was like, oh, this is fantastic.
Super dope. Like multiple buffets, all that jazz. But it's great for that kind of stuff. It's great because there's a ton of insurance that comes with a lot of these cards that can protect you, and also medical insurance as well when you're traveling abroad. Which is, you get like a $5 million policy just by, buying the plane ticket with your card, right? Which is fantastic. Fraud protection, you literally like, no matter what happens, if you see some stuff that doesn't look right, you just call them up and it's just like instant.
Yeah.
There's so many protections and benefits to it. You just have to pay back.
Yeah,
you just have to pay. That's all you have to do is just pay back what you spend. And a lot of people can't get that right. If you can, they're just like, they're the most they're an insane tool and it makes no sense to spend cash. But if you don't have the greatest habits with that, then you might want to focus on that before trying to get into the whole credit card game.
Yeah. And you also brought up cars and like how a lot of people our age are just buying expensive cars for no reason, cars that they can't afford. When it comes to buying a car, like what do you think is the best way to go about it? Is it leasing? Is it just buying kind of like a cheap, like, I don't want to say beater, but just like, something that'll get you to point A to point B reliably. Yeah. Well, what are your thoughts?
I still am driving my beater from like college. And I'm constantly getting yelled at by my mom and girlfriend to just sunset that thing. Right. And I can't, because it's just, dude, I paid like $5,000 for it. Like, God, like 6-7 years ago, right? And it's still going strong. It's like over 300 clicks on it. And I'm like, dog, like I can't go from like not paying like paying like $100 in insurance or whatever it is to like all this other stuff. I got to put all this money down, whatever. So I think the smartest way to go about it is to do that. Not a beater, but like, I love Japanese cars. Get a nice Japanese car that's
reliable.
For a few $1,000s when you're younger, and just maintain it. Just keep that. The worst thing you can do is like get a brand new car or like a car that, because you've heard the thing, you drive off the lot, loses 10% of its value, then 15, 20, whatever. So you're in the hole and you're in like, you have negative, you're basically in the hole right away.
Yeah.
And again, a lot of people just get a new car because they think that's what they should do. And they're like, well, it's, it's a long-term thing. It's like, no, just get a beat or whatever, who cares? And then when you're doing better financially, you don't have to be like insane like me, because I've definitely should have got a new car like 3 years ago. But like, then you can like graduate and maybe pay for cash, for a nicer car, maybe, 20 or 25 grand or whatever, right? If you're doing well financially, right?
But you're saying cash, like, or if you have the money.
It depends. Like, so when interest rates were lower, how you have to think about it is like interest rates are quite high right now.
Mm.
For a lot of people, when you're taking out money, you need to think about how much money can I get in the market right now? Or, what's the return on investment I can get if this is invested? Because if I can get a loan for 1%, I'm going to take that because I can put the money that I would have put locked up in that loan and then put it in the market. And it makes sense mathematically. When rates are like 6, 7, 8%, it's extremely difficult to be like, wow, I'm going to get that kind of return or whatever. So when you pay down debt, it's a guaranteed quote unquote return because it's money you won't have to pay back, right? Versus like the market, it's actually like unsure. So when interest rates creep up past that 5% mark, it might make more sense to pay cash or at least put like a lot of money down or however much you can put down and have a smaller loan. But when interest rates were how they were before, like it would make more sense to just like get the loan, keep those nice terms, and invest more, invest the excess cash. So it's just it really depends on the interest rate of the loan.
Yeah. And then the other thing you said is like the two biggest problems that people put themselves in is the like what they drive and where they rest their head.
Yeah.
So when it comes to where they rest their head, what are your thoughts on renting versus owning? Because I feel like this is such a big topic, and so many people say like, oh, renting is just throwing away money and this and that. Like for people in their early, mid, late 20s, like what are your thoughts on renting versus owning a home?
Yeah, man. I mean, I think for the most part, like you should be renting. Like I'll go on the record and say like you should be renting. I think that's in general. Like if you're some like hot shot, whatever, you've got more cash than you know what to do with, and maybe you can get a home. But I think generally speaking, a home is more of like a consumption good than it is like an asset. People think they'll plow money into it and building equity and it's an investment. I think the returns on a home, if you're not like real estate investing is different. Like if you have a home and you're renting it out and you're cash flowing a few $1,000 a month or even a few $100 a month, that means your mortgage is getting paid, your property taxes are being paid, and you're building equity and you're paying down your debt or whatever, right? So that makes a lot of sense financially. But like when you're getting no money from that place and it's just costing you money, that offsets the return in a lot of ways. You need a new roof, again, property taxes or, something goes wrong. It's just a headache, whatever. It doesn't really make too much sense early on when you could be just, rent, keep your costs low, focus on your career, grow your money, grow your wealth, et cetera, your income and everything like that. And then over time, how I think about it for me, I rent right now. I think when I want to get married and have kids, I want a home not because of the financial return, but because I want to own my home and I just want to like have a place for my family that I can call my own. But that's unfortunately that's a privilege now is home ownership. It used to be sort of a right, and I think people still believe it is. But just the way it is in the GTA, and not really speaking elsewhere, but in the GTA, it's kind of like a privilege to be a homeowner, right? Because it costs so much money, and a lot of people our age got on the market a few years ago. And they're drowning right now, bro, because they have a variable rate and they can't make their mortgage payments. And their parents are helping. Like, I know this. Their parents are helping them pay off their mortgage, or they're literally had to move back home, and then rent out the place to actually get a bit of cash flow, right? So it's like, sure, you own your condo, but it like sets you back financially years. Versus like if you just thought about it like more pragmatically, it's like, yeah, maybe I'll just wait. And maybe instead of getting it at 26, I get it at 33, and like that's okay.
Yeah.
That's fine. But you're not throwing your money away with rent, because if you look at any analysis of it, if you rent and invest the difference versus like buying a home, like you'd be surprised how far out ahead you can become like with renting and investing. So, yeah.
And so you brought up like a lot of people getting screwed right now because of variable rates. So when it does come to, whether it's now or down the road, do you recommend like a fixed rate always, or depends on where the market is at the time?
Yeah, not necessarily. And you definitely want to talk to, experts around you to see what makes the most sense. I think generally people have always said that variable is the most like flexible. Fixed can be quite penalizing if you need to break it for whatever reason. So it's one of those things, man. It's like it's going to come down to your preferences. I think a lot of investors, when they're buying homes, like they like the fixed cost, so they'll do like a fixed term. But I think generally variable has been the sort of like play, but like it does when the interest rate environment changes, like it's going to change how people think about it. So I couldn't really give a very thoughtful answer right now of what you should do. It's always going to depend on your circumstances. But I think for the most part, like if you're going to do a variable rate, like you should be very, very aware of what that can mean with different scenarios, different announcements, things like that. Yeah.
Okay. I have one last question for you
Please,
before
please.
before I let you go. You've mentioned this before in your videos, and I think the first time I heard it was listening to Joe Rogan's podcast. But it's the term, and I love this term, but like fuck you money.
Yeah, yeah,
Can you explain to people what exactly FU money is
yeah.
and why it's important, or why it's obviously a good position to be
Yeah,
in?
dude, I love the thought of FU money. I think everybody in some way, shape, or form aspires to have FU money, and essentially, it people have different definitions. My definition is you have enough money that you really don't care if something goes sideways
Yeah.
or whatever. You're financially secure pretty much for life. And so if your boss is giving you shit or whatever, like you could just tell him to F off,
Yeah.
or like, hey bro, I don't need this job. Like I'm here because I like it and I enjoy what I do, but like I don't need this. And I think that kind of energy in your life is not combative, but I just like it because it's like, yeah, like it gets people going and it gets them thinking about all the stuff we just talked about for the past hour, right? But the concept generally is putting away enough money. I did a video that's coming out soon where, your FU number is typically going to be 25 times your desired annual spending. So like, let's say you wanted to be able to spend 100 grand a year.
2.5.
2.5, right? If you wanted to have 400 grand a year, it'd be 10 million. Like it gets up there and up there and up there.
Yeah.
But like
Everyone has a different number.
typically that's what your FU number is going to be based on. And it's sort of derived from the 4% rule, which is this whole other thing. But basically that's how you can think about it. How much you want to have, how much you think you could be good forever with per year in income, and multiply that by 25. And then like, that's your like North Star that you can work towards over the next like decade or 2 decades or whatever. Yeah.
Is the 4%, and I feel like I've heard this before, I could totally be wrong, but it's like if you were to take out 4% every year,
Yeah.
you would still, from what you have already in there, it would be able to grow at a rate where you're not losing money, or like you can take care of yourself.
Exactly. Yeah. It's sort of like the golden number that most portfolios that are reasonably managed, that have a good portion of equity and bonds, or like maybe more equities, with just stocks basically. 4%, a 4% withdrawal historically has been pretty consistent in the vast majority of times where, like, let's say 30, 40 years, you run a simulation, like 85%, 90% of the time, it's not going to run out of money. That changes how the portfolio, it changes with the portfolio of what it is. So like if it's more equities, typically it could go longer. If it's more risk averse, then maybe it could be shorter. Those are generalizations. It really does depend on the underlying assets. But generally, that 4% rule has stood the test of time, to where it's like it's enough to like actually like take care of yourself and like actually enjoy your money. But it's not insane to expect a 4% compounded return over time. So like you can have money indefinitely, right? So it's kind of like that golden number. People argue about it all the time and say, it's dead. The 4% rule's dead. It should be 3% or it should be 5% or whatever. I just say, man, 4%. And like the last thing I want to say about that is people who have that kind of money, man, like they've got money coming out of so many other different ways too, that a lot of times they don't even need to draw on their portfolio till they're actually retired in their 50s and 60s, because this whole financial independence, retire early movement, like they retire, but they're still working.
Yeah.
And they wouldn't get to where they have got if they weren't like, if they didn't enjoy working and enjoy starting businesses or enjoy their career or whatever it is. So it's not really something you need to stress. Like you hit 35, you hit 40, you hit 45, and now you're taking out 4% every year. Like most often people just don't even touch it. It's just sort of like a security thing to be like, okay, I really don't need to listen to this guy's BS right now.
I could do this if I wanted to.
Yeah, exactly. But most people are just like, I don't really even need to touch it. So
yeah, I like that.
Yeah.
Nate, thank you so much for coming on, man. I would love to have you on again if you're down. I know it's quite a drive for you. There's so many questions I have. So yeah, thank you so much to everyone listening. Appreciate you guys so much for tuning in. If you want to shout out any of your socials or anything like that.
Yeah, man. New Money Nate. I have a newsletter called The Career Earner, where I help folks who work their 9 to 5. How do you make more money at your job? That kind of stuff. But yeah, man, so fun to be here.
Thank you, man. Thank you. All right. Thank you guys so much for listening, and we'll see you next week. Peace.